Bruce, I'm going to start with you. You just put out this note, and if I'm reading it correctly, you're expecting GDP in the U.S. in the second quarter to drop 14%?
I see it.
Yeah, that's correct.
Okay, how do you get to that number?
Well, you basically shut everything down in March and April. Obviously, it's not just the U.S. It's happening in Western Europe. It's now increasingly happening across the world. So we have this enormous disruption that is not limited just to spending on entertainment and travel. It's spreading out to closing industries, and it does enormous damage not just to GDP but to labor markets. I think we saw the first step of that in today's jobless claim numbers. I don't think right now there is really any question that we're going to have an intense hit here and it's going to take second quarter growth down a lot. The real question is how long does this last and how do we recover from it? Right now, we still have a decent recovery in the second half of the year, which incorporates a fading of the virus drags and an opening up of activity, but still some important lingering damage in credit markets and industries that have been hurt. The question right now is, can we stem the damage being done in a way that those lingering effects are just limited?
Yeah, Tobias, in the meantime, today, the S&P right now is basically right around the flat line. 2396 is the level currently that it's trading at. Just looking at one of your recent notes, you've drastically reduced your S&P target for the year to 2825 from 3375. So much lower, but still represents some upside. How are you forecasting? What is your modeling for that?
So we run about 9 to 12 different ways of kind of achieving that, Morgan. And what I would say is that we're starting from a much lower base, which is one of the problems. The earnings estimates as well. I mean, I share Bruce's comments about duration. How long does this last? And if it's 4 to 6 weeks, that's fine. If it's 4 to 6 months, there's still maybe some more pain. One of the things that's interesting to us is that when you look historically on trailing earnings as opposed to forward earnings, which are the place where we have the biggest difficulty forecasting. But on trailing earnings, between 14 and 16 times estimates, or actual results rather, has been kind of the second best place to buy the market over the past 80 years in terms of subsequent market performance. And that would be somewhere between 2,300 and 2,600 on the S&P. So, where we are right now does suggest valuation is already reflecting a lot of bad news. And even if we run numbers suggesting recessionary calls of maybe $130, $135 on the earnings estimates, we can still see markets in the 2,400 to 2,500 range. In that context, there is some opportunity here. The problem is that sentiment is still, not in panic territory. In January, last comment here, our panic euphoria model was in euphoria, warning us 70% probability of downside to the market. We're fairly neutral now. We're not in panic level. And again, we're not measuring emotional states. We're measuring where, people are positioned. I know it's shocking, but we haven't gotten to people kind of giving up. Everyone's looking for that bottom. Everyone's looking for where the opportunities for the bounce back are. And I think there's got to be a level of disgust and revulsion towards equities to really hit that bottom.
And Tobias, for Goldman, for example, that number is 2,000 on the S&P mid-year. Do you have a number like that?
So we don't, but I would suggest that if you break and I'm not a chartist, I'm not a technician, but a lot of our clients do look at these charts very carefully, that if you break the 2340, 2350 levels that we saw in December 18, I know our technicians are talking about, potentially seeing, 2100 is kind of the next level where there can be some support. Again, it's not where we come from a fundamental perspective, but I can look at the chart just as easily as anybody else does. And I think there's an element of people saying, if I've got nothing else to look at, I'm going to look at the chart.
Yeah, Bruce, I'm curious what you think the Fed response right now, the fiscal response, all of these different phases in terms of bills that are being drafted by the federal government right now, some of these other actions, how much that could actually quell the worst of the economic damage here in the U.S. and how that factors in.
So I think what the Fed is doing is very important and very helpful, not just in easing policy, bringing rates to zero, but also in terms of trying to make sure markets are functioning, really stemming the tide of pressures in the Treasury market now beginning to move into some other areas as well, commercial paper and specific. I think right now the really big issue is there's a lot of pain that's going to be felt in a very concentrated way in company space and people losing their jobs. And we need to not just get fiscal stimulus in the picture, we need to get targeted help. And the question I think we need to ask as we look at the package that's evolving in Washington is how quickly and how effective will those targeted benefits come. I think the jury is still out on that, and it will be an important factor in terms of how quickly and how strongly we can recover from what's going to be a big hole in the second quarter.